Warren Buffett bought 130 million ounces of silver in 1997. He never told anyone until he was legally required to disclose it. Bill Gates' foundation holds silver mining stocks. Ray Dalio publicly says, buy gold, but his fund quietly accumulates silver positions. Elon Musk's companies consume thousands of ounces monthly, and he stays silent about supply constraints that could cripple his business. Why? Because billionaires don't buy silver the way you buy silver. They don't think about it the way you think about it. And they certainly don't talk about it publicly until after they've positioned themselves. By the end of this video, I'm going to show you exactly how the wealthiest people on Earth approach silver. Not theory, not speculation. Documented strategies pulled from SEC filings, corporate disclosures, and vault delivery records. And once you see the pattern, once you understand why they buy physical delivery, why they take possession, why they never sell, you'll realize the game is rigged. But you can still win if you play by their rules instead of the rules they tell you to follow. This isn't financial advice. This is pattern recognition. Let's go. Here's what you need to understand first. There are two completely different silver markets, the paper market and the physical market. And billionaires only play in one of them, the paper market. This is where 99% of people buy silver, ETFs like SLV, futures contracts, mining stocks, certificates, allocated accounts at banks, convenient, liquid, easy to buy and sell with a click. But here's the problem. You don't own silver. You own a promise of silver, a derivative, a claim on metal that may or may not exist. The physical market. This is where billionaires operate. Actual bars, actual coins, delivered to private vaults, fully allocated, segregated, no counterparty risk, no bank middleman, no leverage. Just metal in your name in a specific location you control. Now ask yourself, if you had $1 billion and you wanted exposure to silver, which market would you choose? The convenient paper promise or the inconvenient physical reality? Every single billionaire who's disclosed silver holdings chose physical. Everyone. That's not a coincidence. That's the signal. Let me show you the pattern. It's the same pattern across every billionaire who accumulates hard assets. Stage 1, quiet accumulation. They don't announce it. They don't tweet about it. They buy through shell companies, family offices, private trusts. Quietly, slowly, over years. No fanfare. Why? Because announcing your position drives up the price before you finish buying. And billionaires didn't become billionaires by overpaying. Stage 2, physical delivery. They don't leave it with the broker. They don't trust allocated accounts at major banks. They take delivery, ship it to private vaults in Switzerland, Singapore, Delaware, segregated storage, their bars, their serial numbers, no rehypothecation, no lending. Stage 3, long-term hold. They don't trade it. They don't sell when it goes up 20%. They accumulate and hold. Generational wealth preservation. This isn't a trade. This is insurance against monetary collapse, inflation, geopolitical chaos. It's the asset you buy and forget about until everything else fails. Stage 4, public silence or misdirection. They don't talk about it, or if they do, they downplay it. Buffett called silver speculation, then bought 130 million ounces. Dalio says, buy gold, buries silver positions in footnotes. Why? Because the last thing they want is retail competition driving up prices before they're done accumulating. That's the pattern. Quiet, physical, long-term, silent. Now let me prove it. Warren Buffett, 1997, Berkshire Hathaway, discloses they've been accumulating silver for months, 130 million ounces, nearly 20% of annual global production at the time. The announcement shocked markets. Buffett never buys commodities. His whole investment philosophy is productive assets, businesses, cash flow. So why silver? In his disclosure letter, he said this: equilibrium between supply and demand was only likely to be established by a somewhat higher price. Translation, supply deficit. Price too low, opportunity. He bought physical, took delivery, stored it in London vaults under Berkshire's name, not SLV, not futures, physical bars. He held for 7 years. Prices went from $4.50 to over $7. He made hundreds of millions, then quietly sold. But here's what matters. He didn't trade paper. He didn't use leverage. He bought physical, took delivery, and waited. That's the billionaire playbook. Bill Gates. The Gates Foundation doesn't directly hold silver, but look at their equity portfolio. Silver mining stocks. Significant positions in companies like Pan American Silver, First Majestic. Why would a tech billionaire's foundation own silver miners? Because mining stocks are leveraged plays on physical silver prices. When silver doubles, miners can 5x or 10x. But here's the key. Gates isn't buying SLV. He's buying the production source, control upstream, profit downstream, strategic positioning, Ray Dalio, Bridgewater Associates, one of the largest hedge funds on earth. Dalio has written extensively about gold. His all-weather portfolio includes gold. He talks about gold constantly. But look at Bridgewater's 13F filings, silver positions buried in footnotes, SLV, PSLV, silver mining equities. Not huge percentages, but consistent. Quietly held. Why doesn't he talk about silver the way he talks about gold? Because he's still accumulating. And the last thing you want when accumulating is a crowd. Elon Musk. Now this one's interesting. Musk doesn't hold silver personally as far as public records show, but Tesla consumes massive amounts of silver. Every vehicle has 1 to 2 kilograms. Solar panels from Solar City operations need silver paste. SpaceX components use silver for conductivity. His companies are structurally long silver. They need supply security. And Musk has never once publicly addressed silver supply constraints or price risk. Why? Because drawing attention to silver scarcity would spike prices and hurt his cost structure. Silence is the strategy. Acknowledge the dependency and you create a squeeze against yourself. The Saudis. Saudi Arabia's sovereign wealth fund, PIF, has disclosed positions in precious metals including silver through various investment vehicles, not publicized, not discussed. Quietly diversifying oil wealth into hard assets. The Chinese billionaires can't legally buy large quantities of physical precious metals directly due to government restrictions. But Chinese state entities and connected private firms buy silver mining companies, refining operations, vault storage businesses, controlling the infrastructure. Jack Ma's affiliated investment firms have stakes in commodity-related businesses. It's indirect, strategic, structural. The pattern holds. Stanley Druckenmiller, legendary macro investor, in 2020 he publicly said he was buying gold. Interviews, conferences, very public. But in his fund's filings, silver positions appeared quietly, not headlines, footnotes. He knows what gets retail excited versus what he actually wants to accumulate without competition. These aren't coincidences. This is a playbook. And the playbook is consistent. Now let me show you how they actually execute, because buying physical silver at scale is not like buying stocks. It's complicated, it's deliberate, and it reveals intent. Step 1, entity structure. Billionaires don't buy in their own name. They use family offices, LLC structures, offshore trusts, private investment vehicles. Why? Privacy, tax efficiency, legal protection. When Buffett bought silver, it was through Berkshire, a public company, so disclosure was required. But most billionaires use private structures. No disclosure requirements, no public scrutiny. Step 2, sourcing. They don't call 1-800-BUY silver. They go direct to refiners, mints, wholesalers, negotiate bulk pricing, no retail premiums, buying 1,000-ounce bars at spot plus 50 cents, not 1-ounce coins at spot plus $5. Volume discounts, wholesale relationships. Step 3, delivery and storage, private vaults, not bank safety deposit boxes, not SLV's unallocated pool. Fully allocated, segregated storage in jurisdictions with strong property rights and political stability. Switzerland, Zurich, Geneva vaults, Brinks, Loomis, Viamet, Singapore, Freeport Storage, Malka Amit, Certus, Cisco, Delaware, Wilmington vaults for US-based entities. London. While Buffett used London initially, many have since diversified away due to regulatory changes. The key, specific bars, specific serial numbers, specific vault location, third-party audits, no commingling, no lending programs. Step 4, insurance and security. Fully insured, separately insured, not under the vault's blanket policy, Lloyd's of London policies, armed transport. Confidential logistics. This isn't paranoid. This is protecting 9-figure positions. Step 5, multi-jurisdictional diversification. They don't keep it all in one country. Political risk, expropriation risk, regulatory risk, spread across multiple countries, multiple vaults, multiple legal structures. If one jurisdiction goes sideways, the others are protected. Now here's what they know that you don't. The paper market is fractional reserve. For every ounce of physical silver, there are between 50 and 250 paper claims. COMEX registered inventory, 43 million ounces available for delivery. COMEX open interest represents hundreds of millions of ounces in claims. SLV prospectus disclaimer, they can settle in cash if physical unavailable. LBMA unallocated accounts. Basically IOUs, no specific bars. The system works as long as most people accept paper settlement. Cash instead of metal, rollover instead of delivery. Billionaires know this, so they don't participate in the paper game. They take physical delivery and remove the metal from the system. Why? Because when the paper market breaks, when confidence cracks, when delivery failures cascade, paper claims will be worth pennies on the dollar. But physical silver in your vault, that's worth whatever physical silver trades for in the real world, and that price will be multiples higher than the paper price. Here's the strategy breakdown. Most people buy silver like this, see silver price pumping, get excited. Buy SLV in their brokerage account. Price drops, panic sell, lost money. Never understood what they owned. Billionaires buy silver like this. Identify long-term structural deficit in physical market. Spend 6 to 12 months quietly accumulating physical at wholesale prices. Take delivery to private vault. Forget about it for 10 years. Price volatility is irrelevant. It's insurance, not a trade. When monetary crisis hits, they're positioned. See the difference? One is gambling. One is strategic positioning. One is reacting. One is anticipating. One is paper. One is physical. And that's why billionaires win. Now let me tell you what you can learn from this. You're not Warren Buffett. You don't have $100 million to drop on silver, but you can apply the same principles at your scale. Principle 1, physical over paper. If you're buying silver for wealth preservation, for insurance, for long-term holding, buy physical. Coins, bars. Take delivery. Put it in a safe. Don't leave it with the dealer. Don't trust allocated accounts you can't audit. Own the metal. Principle 2, buy wholesale whenever possible. 1 ounce coins have $4 to $5 premiums. 100 ounce bars have $1 to $2 premiums. 1,000 ounce bars have even lower premiums if you can store them. The bigger the bar, the closer to spot you pay. Billionaires buy 1,000 ounce bars. You might buy 10 ounce or 100 ounce, but avoid high premium collectibles unless that's your hobby. You want silver content, not numismatic markup. Principle 3, long-term hold, not trading. Don't buy physical silver to flip it in 6 months. The spreads will kill you. Dealers charge $3 over spot to sell you a coin, then offer $2 under spot to buy it back. That's a $5 round trip. You need silver to move 20% just to break even. Physical silver is for holding. 5 years, 10 years, 20 years. If you want to trade silver price, use futures or mining stocks. But if you want to preserve wealth, buy physical and don't touch it. Principle 4, diversify storage. If you have $10,000 in silver, keep it in a home safe. If you have $100,000 in silver, split it. Half in home safe, half in private vault or bank safety deposit box in a different state. If you have $1 million in silver, you're playing a different game. Multiple jurisdictions, multiple storage facilities, offshore trusts, because at that level, you're protecting generational wealth, and single points of failure are unacceptable. Principle 5, silence. Don't brag. Don't post your stack on social media. Don't tell your neighbors. Billionaires don't announce their positions for a reason. Security, optionality, competitive advantage. If you're accumulating physical silver, shut up about it. Buy quietly, store securely, and wait. The power is in the silence. Here's what billionaires know about timing. They're not trying to buy the bottom. They're accumulating during periods of complacency when no one cares. Buffett bought silver in the late 1990s when silver was boring. No one talked about it. Industrial demand was stable. Mining supply was steady, prices were low. He accumulated for months before the market even noticed. He didn't wait for confirmation. He didn't wait for momentum. He bought during indifference. Then he waited for the inevitable supply-demand imbalance to play out. That's the billionaire mindset. Anticipate, don't react. Right now, where is silver sentiment? Retail interest is moderate. Some excitement, but not mania. Industrial demand is surging quietly. Solar, EVs, 5G. Supply is constrained. Mining production flat. COMEX inventory is draining. But the mainstream isn't panicking yet. That's the window. That's when billionaires position, not when CNBC is screaming about silver shortages. By then, it's too late. The smart money already owns it. The question is, are you early or are you waiting for permission? Let me show you the risks they account for. Because billionaires don't just blindly buy. They hedge, they diversify, they plan for scenarios. Risk 1, confiscation. FDR confiscated gold in 1933, Executive Order 6102. Could the government confiscate silver? Possible, but less likely. Silver wasn't confiscated in 1933 because it was still in coins. Industrial use makes outright ban difficult. But billionaires plan for this. They store internationally. Switzerland has strong property rights. Singapore has no history of confiscation. Diversification mitigates single jurisdiction risk. Risk 2, regulatory changes, reporting requirements, transaction limits, precious metal dealer regulations. In the EU, cash purchases over $10,000 require reporting. In the US, certain transactions trigger IRS Form 8300. Billionaires structure around this, trusts, offshore entities, legal structures that comply but maintain privacy. Risk 3, illiquidity. Physical silver is not liquid like stocks. You can't sell 10,000 ounces in 30 seconds. Finding buyers at fair prices takes time. Dealers pay under spot. Private sales require trust. Billionaires accept this. They're not buying for liquidity. They're buying for preservation. If they need liquidity, they have other assets. Silver is the bunker wealth, the last resort. Risk 4, volatility. Silver is volatile. It can drop 30% in months. Billionaires don't care. They're not leveraged. They're not on margin. They own it outright. A 30% paper loss is irrelevant if you're holding for 20 years. They understand that volatility is the price you pay for asymmetric upside. Now let me tell you what happens when everyone figures this out. Because the billionaire strategy works as long as it's quiet. But if millions of retail investors start doing what billionaires do, demanding physical delivery, removing metal from the system, the game changes, the paper market breaks, comics can't deliver, ETFs suspend redemptions, premiums explode. Suddenly, paper silver is $25, but physical silver costs $50 to actually buy. That's the two-tier market, and that's when billionaires win. Because they already own the physical, they took delivery years ago at $20. Now retail is scrambling to buy at $50. Dealers are sold out, mints have year-long waiting lists, and the billionaires sit quietly, holding metal that's appreciating while paper burns. That's the end game. That's why they take delivery now. Here's the difference in mindset. Average investor thinks silver is at $24. If it hits $30, I'll make 25%. Nice trade. Billionaire thinks the monetary system is built on $35 trillion in debt that can never be repaid. Currencies are being debased at 7% to 10% annually. Central banks are trapped. When confidence breaks, hard assets will be the only store of value. Silver is undervalued relative to gold, to industrial demand, to monetary chaos. I'll accumulate physical now while it's boring. In 10 years, the price won't matter because the price will be denominated in a currency that's collapsing. See the difference? One is trading, one is surviving, one is chasing returns, one is preserving wealth across generations, one is thinking in months, one is thinking in decades. And that's why billionaires buy physical silver, not for profit, for insurance, not for speculation, for survival, not to get rich, to stay rich when everything else fails. So here's my question to you. Are you going to keep playing the paper game, trusting the system, hoping your SLV shares are actually backed by metal? Or are you going to do what billionaires do? Buy physical, take delivery, store securely, hold long term, stay silent. The choice is yours. But understand this. Billionaires aren't smarter than you. They don't have secret information. They just play by different rules. They buy assets that can't be printed. They take possession. They think generationally. And they don't wait for permission from CNBC to make a move. The window to buy physical silver at reasonable premiums is still open, but it's closing. Dealer inventories are tighter. Premiums are rising. Delivery times are extending. The billionaires are positioned. The institutions are accumulating. The question is, are you? Or are you going to wait until the paper market breaks? Until premiums are $20 over spot? Until dealers are sold out and wish you'd acted when you had the chance? If this made sense, if you see the pattern, subscribe now. Because what I've shown you is just the beginning. The Billionaire Playbook extends beyond silver, real estate, commodities, farmland, offshore structures, tax strategies, generational wealth preservation. In the next video, I'll show you how the ultra-wealthy are positioning for the next phase. The currency reset, the debt collapse, the great transfer of wealth from those who trust the system to those who prepared for the system to fail. Subscribe. Watch the next video. Learn the playbook. Because people who see the pattern early don't just survive the collapse. They position themselves to thrive on the other side. The clock is ticking.